Good morning, everyone. Around the world and here at home, financial services are slowly moving toward open banking and open finance. A more decentralized consumer financial market structure has the potential to reshape how companies compete in the sphere. This week, the CFPB will launch the process to activate a dormant authority under Section 1033 of the Consumer Financial Protection Act that I expect will accelerate this shift. The provisions provide for personal financial data rights for Americans, but would only have teeth after the CFPB defined the specifics through rules. And now, while not explicitly an open banking or open finance rule, the rule will move us closer to it by obligating financial institutions to share consumer data upon consumer requests, empowering people to break up with banks that provide bad service, and unleashing more market competition. If successful, it will also reduce the ability for incumbents to build moats and for middlemen to serve as gatekeepers. It will provide big advantages to those who provide the best products, service quality, and rates. Today, I want to start off by talking a bit about the CFPB's new approach to regulation. Then I'll describe what some of the features of a more open and competitive market would look like, along with where individual consumers and new firms will have more leverage and opportunities. I'll then outline some details about where we are headed, as well as what we're hoping to avoid. And I'll close by discussing the timeline and next steps to get this done. A few words about our approach to regulation. Regulation of the financial services industry has a bad name, and rightfully so. Financial regulators have largely complied with what dominant firms desire by writing complicated rules to fit existing business models. Much of it involves financial institutions handing consumers a lot of fine print that they may not even read, like those financial privacy notices companies send. It's a lot of busy work and a lot of paperwork. At the CFPB, we are shifting away from this failed approach, and instead we are looking to create catalysts for more competition. There are so many forms of pro-competitive regulation, such as rules that reduce switching costs or barriers to entry, rules that promote price transparency in shopping, rules that reduce conflicts of interest, and rules that place limits on business activity in order to ensure that firms don't exploit their control over critical networks. Ideally, these rules are bright lines that require a minimal number of lawyers who bill by the hour. Telecommunications in the United States has several noteworthy examples of this. The Federal Communications Commission's number portability rules reduce switching costs by allowing customers to move their phone number to a new carrier more easily. This jump-started more competition in the marketplace. And decades before that, the so-called Carter phone rules ensured that new devices could be interoperable with AT&T's network through standardized jacks and plugs, even if they were produced by third parties. These and other successful examples of regulation that decentralize market power are guiding our financial data rights rulemaking. With this in mind, here is what we think a more open and competitive market could look like. First, individuals and nascent firms would have more bargaining leverage. In today's market, consumers can often permit access to their financial information through data brokers, sometimes referred to as data aggregators. But the broader overall regime is broken because consumer access is based on a set of unstable and inconsistent norms across market participants. For example, even when large institutions that share personal data with their customers use APIs, there's no guarantee those institutions don't play games on availability, on latency, and critical data points like price. We expect that these games will become much more difficult for incumbents to play in a more competitive market. Specifically, we expect that the public will have more leverage once data holding companies share authorized consumer data with authorized third parties. And this will lead to more shopping by consumers, both because they have the leverage to walk away and because they'll have access to more tailored products and services. For instance, individuals who want to switch providers will be able to transfer their account history to a new company so they don't have to start over if they are unsatisfied with the service provided by the existing firm. Likewise, nascent and new companies would be able to use data permission by consumers to improve upon and customize, to provide greater access, and to develop new products and services. Now, under the current regime, nascent firms often find themselves in the position of needing to curry favor with big market players. In addition, we also see a world where there would be better security of personal financial data. One reason that the current ecosystem is unstable is that many companies access data through activities like screen scraping. However, such methods are not secure and they are likely not sustainable in the long run, especially as standards evolve to a point where those activities could become blocked. Now, if a firm is required to make a person's financial data available to them or to a third party acting on that consumer's behalf through a secure method, we'll be able to mitigate some of the problems that exist today. For example, consumers who want to link their accounts with an app that helps them budget, make payments, or find a route to affordable credit would be able to do so without necessarily having to provide login credentials to third parties. People would feel more secure knowing that both the data holder and the data receiver follow secure practices. For Americans to be confident that they have the consumer financial product that is right for them and their specific needs, they should be able to share their data readily but safely. Third, we think that there should be more switching and more incentives for better service. In an open and competitive market, it should be easy for individuals to fire or walk away from their existing financial provider for whatever reason. For example, for most consumers, changing a bank account is a huge pain. Direct deposits need to be reset, as do scheduled payments linked by ACH or debit card. And consumers need to take these actions while managing their own day-to-day liquidity issues. Our thought is that we could facilitate third-party companies that offer services to make switching recurring payments more easy. Importantly, a more open market will also mean consumers won't have to start from scratch. For example, Americans often use their deposit account history as a life financial ledger. It's a written record that keeps track of who paid you, where you got money from. It's helpful for taxes, for disputes with merchants, for insurers, and so much more. By allowing consumers to own that ledger and bring it someplace else, we hope that switching institutions will be easier. You won't need to maintain a relationship to keep that written record. A competitive market would also lead to unbundling, where companies compete on individual products rather than relying on captive customers or cross-selling scams. When markets aren't competitive, we feel we need to buy additional services from a provider we already have been working with. But with more seamless integration, this will give us all more choice. Fourth, more switching would lead to greater efforts by firms to maintain or win customer loyalty in new ways. And as for companies looking to draw in new customers, when consumers authorize transfers of their personal financial data, new providers will be able to treat them as if they've been long-term customers. Because of the authorized data, companies will immediately know the products and services that could best fit this person's needs. Large incumbents will find that their customers are less sticky and easier to poach. They'll also find it harder to impose junk fees and harvest personal financial data for their exclusive use. And finally, financial companies will be able to find new ways to underwrite and score with less bias. Today, many companies are already looking at new underwriting models that return to core principles, assessing ability to pay without attempting to use outside information that doesn't necessarily make sense. Transaction data will be especially useful for these purposes and may help bring an end to the current reliance on those 3-digit social credit scores derived from credit reports that are cloaked in secrecy and rife with inaccuracies. Rather than rely on black box models that people can't make sense of, lending can move back to real-world data about someone's credits and debits and their ability to pay back a loan. This will reduce bias and reliance on credit scores and other proxies. With this new competitive landscape in mind, here is where I think we're heading. First, we expect to propose requiring financial institutions offering deposit accounts, credit cards, digital wallets, prepaid cards, and other transaction accounts to set up secure methods like APIs for data sharing. While we expect to cover more products over time, we're starting with these ones. Through these transaction accounts, our rule will be able to facilitate new approaches to underwriting, payment services, personal financial management, income verification, account switching, comparison shopping, and more. Starting here will also mean that our jumping off point is where industry infrastructure for consumer authorized data sharing is already taking shape. So we won't be starting from scratch. Second, we'll be looking at a number of ways to stop incumbent institutions from improperly restricting access when consumers seek to control and share their data. We'll be developing requirements to limit misuse and abuse of personal financial data as well as frauds and scams. A common point of concern among jurisdictions around the world is how actors will look to harvest and hoard consumer financial data as it increases scale. Data can be monetized sometimes in nefarious ways or even used by state and non-state actors. And while Americans are unfortunately becoming numb to routine data breaches like the massive ones at Equifax, we know that more needs to be done to stop this underworld from intercepting even more highly sensitive personal data. So we're exploring ways to ensure that when consumers share their data for a specific use, that is the only use it will be used for. We know this will be a challenge, given how difficult it has been to enforce restrictions like purpose limitations and data deletion requirements. I've asked that our staff look at alternatives to the so-called notice and consent regime that has been the standard for financial data privacy. For example, many of you know the long-standing Gramm-Leach-Bliley Act privacy rules. These don't give consumers meaningful control how their data is being used, just essentially a notification. When a consumer permits their private data to be used by a company for a specific purpose, it should not be a free pass for a firm to exploit that data for other uses, no matter what they put in the fine print. Third, we are exploring safeguards to prevent excessive control or monopolization by one or even a small handful of firms. A decentralized open ecosystem will yield the most benefits for creators and consumers alike. At the same time, there will be strong incentives for gatekeepers and intermediaries to emerge, to extract rents and to self-preference. In consumer financial services, we have a number of highly concentrated submarkets: the credit reporting conglomerates, the card networks, the core processors, and more. It is absolutely critical that no one owns any critical infrastructure. For example, in telecommunications, the open internet, powered by protocols like the original hypertext transfer protocol, helped to create the new World Wide Web, and no one owned this internet. And of course, many actors have sought to, and in some cases successfully, grab more control. Threats to openness have come from web browsers, operating systems, app stores, infrastructure providers, and others that already have scale or provide a must-have component. There will undoubtedly be similar efforts when it comes to open banking and finance, potentially from big tech firms or a consortium of incumbents operating today. We're thinking through how standard setting could be rigged in favor of some players over others, where an intermediary or platform could undermine the benefits of an open ecosystem. In terms of process on this rulemaking, here's what you can expect. The CFPB is subject to a rulemaking step that is unique among financial regulators. Before issuing the proposed rule, we will convene a panel of small businesses that represent their markets to provide input on the proposals. So this week, we'll be publicly releasing the discussion guide that small firms can weigh in on. Through that process, we'll hear from small banks and financial companies who will be providers of data, as well as the small banks and financial companies who will ingest the data. We'll also hear input from the so-called fourth parties, the intermediary data brokers that facilitate data transfers. In the first quarter of 2023, in a few months, we'll publish a report about what the small business input we received. This will inform the formal proposal that we will issue in 2023. We will then finalize those rules in 2024 and move to implementation. There will be many opportunities to provide input and inform the public record through the process. In closing, it is really important that we remind ourselves why the US has historically been a bastion of discovery and progress. We are at our best when our laws and rules facilitate and not block seamless switching, reduce barriers to entry, eliminate conflicts of interest, and prevent infrastructure providers from denying access to critical networks. Financial services are such an essential part of our economic plumbing. I believe this so deeply. And we will be working to make sure the market expands and develops new ways to help Americans live their lives to the fullest. A more open ecosystem that is broadly inclusive of consumers, businesses, big and small, holds great promise. I don't think our rulemaking will turn this on like a switch, but I hope it will accelerate it and move us closer to that goal. Thank you very much.